Now we're going to look at the MACD, and since it's really a form of trend deviation indicator, I'll start by saying a few general words on that subject. A trend deviation indicator is obtained by dividing or subtracting a security's price by a measure of trend, which is usually a form of moving average. It's also possible to base a trend deviation using a linear regression technique. However, I'm going to concentrate on the moving average technique here. In some charting packages, the indicator derived from this technique is also called a price oscillator. Since the average represents the trend being monitored, the momentum indicator shows how fast the price is advancing or declining in relation to that trend. This chart shows the price of Brookline Bancorp. The dashed red line is a 50-day moving average, and the two blue lines are also 50-day moving averages, but they've been plotted 5% above and below the real moving average, so they act as a kind of an envelope encompassing most of the price action. An oscillator based on a trend deviation calculation is, in fact, a horizontal representation of this envelope arrangement. If I uncover the rest of the chart, you can see what I mean. The 50-day moving average, in this case, is represented by this horizontal red dotted line at 0. You can see that when the price in the upper panel crosses below the moving average, the oscillator crosses below 0. And when it moves above the average, the oscillator goes into positive territory. Note how the price tried to cross above the average 3 times here. So too did the oscillator, but it failed to move above 0. Finally, when the price reaches the plus 5% upper envelope, the oscillator reverses at its overbought zone. Even though the oscillator is giving us the same information as the visual price to envelope arrangement, we can sometimes see things in a clearer way by observing the path of the oscillator. For example, here's the price being contained by a somewhat steep trend line. Steep trend lines are not so significant as less shallow ones, as a general rule, so we may not have paid much attention to it. However, if you look at the oscillator, you can see that it was contained by a more or less horizontal line, which also set up a positive divergence and permitted the construction of a base. This is a far stronger signal and shows these two approaches for the same indicator. I mentioned earlier that there are 2 ways in which price oscillators could be constructed. The previous chart showed the division method, where the close or a short-term moving average is divided by a longer-term one. The other approach is to subtract the close or shorter-term moving average. Now the difference is not that critical on short-term charts where price movements are not that large, but they certainly are on longer-term ones. Of the 2 approaches, division is preferred since it's more reflective of proportionate moves. If a significant long-term appreciation has taken place, the subtraction method will exaggerate the most recent price swings and vice versa. You may recall our discussion in the basic building block presentation on the subject of arithmetic versus logarithmic scales, because the principles are identical. This chart compares the 2 calculations. The middle window subtracts the close from a 10-week moving average for the gold price. As it works its way higher, you can see that the fluctuations grow larger. These 2 dashed lines contain pretty well all of the price movements between 1985 and 2004. But after that it was useless. On the other hand, the division calculation in the bottom window divided the close by the 10-week moving average. And you can see that the plus and minus 10% bands contained pretty well all of the fluctuations for the whole period. The interpretation of a trend deviation indicator is based on the same principles as any other momentum indicator. This method can be used to identify divergences and overbought and oversold zones, but appears to come into its own when used in conjunction with trendline construction and moving average crossovers. Here's a 10-minute close-only chart for Johnson & Johnson with a 1 by 184 price oscillator. In other words, the closing price is divided by a 184-hour moving average. That's approximately a 5-day time span. The first thing to notice is that the oscillator pretty well follows the broad price swings. Here are the price swings, and if I drop them down on the oscillator, you can see that there's a reasonably good fit. Second, because of that fact, the series lends itself to trendline construction. Here's a bullish setup, and here's a bearish one. I can also introduce some overbought and oversold parameters at plus and minus 1.5. Once again, here are the unconfirmed buy signals, and here are the sells. Some of these can be confirmed by the price, like this one, this buy, and finally this sell. The other overbought oversold crossover could not be confirmed because the preceding drop or rally was too steep. Now we're looking at the same period, but this time the oscillator has a much smaller time span, a 1 by 23. Remember, the preceding one was divided by a 184 period moving average. This one's far more volatile and therefore is not so susceptible to trendline construction. In this instance, there are far more overbought oversold situations. Here are the oversolds that all result in a rally of some kind, though usually of a short-term duration. And here are the sells. The dashed red line in this case was premature and a definite failure. Not all tops are signaled with an overbought condition. This one, for instance, developed as the oscillator was barely able to move above zero. A classic above-average decline setup, complete with this small top. So far, my examples have been limited to closing prices being divided by a moving average. But an alternative approach with trend deviation indicators is to smooth out unwanted volatility with the aid of two moving averages. That means the calculation is made by dividing a shorter-term moving average by a longer-term one. The choice of parameters is important. For example, this chart shows a 29-day divided by a 30-day average, but the results are far from satisfactory. This low corresponds closely to this high, so does this one. And when the oscillator is rising, the price is falling. And finally, this rally doesn't even show up on the oscillator. The point is that the two time spans should be separated by a reasonable period. What's reasonable? I'd say more than a double. Here we see the same chart, but this time the oscillator is at a more reasonable 10 by 30. Now these two peaks line up. Also, this decline is matched by a decline in the price, so I change its color to a bearish red. Finally, this rally, which did not show up in the previous oscillator, now shows up. Sometimes it's nice to take a longer time span to get a smoother series and use the moving average crossovers as buy and sell momentum alerts. This chart literally takes us on that course with the S&P Airline Index. The actual trend deviation series is calculated by taking a 26-week moving average of the closing price divided by a 52-week moving average, hence the 2652 contained in the brackets. The second series, that is the red dashed line, is simply a 10-week moving average of the first. Buy and sell alerts are then triggered as the smooth trend deviation indicator crosses above or below its 10-week moving average. The next step is to look for a confirmation from the price itself. Three examples are shown on the chart. One for a bottom just here. Note also that the line is penetrated at the same time as the moving average. Another signal for a top is seen just here. And finally another bottom again with a simultaneous trend line and moving average violation. The ability of a price to violate a line and a moving average offers a much greater probability that the signal will be valid. Now this is very much a guerrilla approach because the buy alert indicated by the dashed arrow was signaled almost at the top of the rally, and this sell signal was not confirmed by a negative moving average crossover. These latter two examples demonstrate the importance of picking and choosing between signals, only selecting those that develop close to a turning point and that are also confirmed by the price action. If this filtering approach is not taken, then there is considerable risk that action will be taken close to the end of the trend. A useful method that generally reduces such whipsaw activity, but still offers timely signals, is to advance the 52-week moving average by 10 weeks when the trend deviation calculation is being made. This means that each weekly close is divided by the 52-week moving average as it appeared 10 weeks before. Now, if you're not familiar with this approach, please look at the moving average section of the basic building block presentation. This new calculation has been plotted in the center panel of this chart, again for the airline index. In this example, the whipsaw in late 2000 was filtered out since the trend deviation indicator failed to cross decisively below its moving average. Now, I'm not suggesting that this is the only legitimate combination for weekly charts, but it is one that appears to operate quite well. There's always a trade-off when you try and make a signal less sensitive, and in this case we find that there is occasionally a small delay compared to the non-advanced 52-week moving average. The most obvious one on this chart developed at the beginning of 1997, where the advanced series in the center panel crossed its moving average at a slightly higher price. In most instances, though, this is a small price to pay if a costly whipsaw can be avoided. The moving average convergence trading method, the MACD, is a form of trend deviation indicator that uses two exponential moving averages, the shorter being subtracted from the longer. The two moving averages are usually calculated on an exponential basis. You'll recall from our session on moving averages that exponential moving averages, or EMAs, give greater weight to the more recent periods and are therefore more sensitive than simple moving averages. It's normal for the MACD to then be smoothed by a third EMA, which is plotted separately on the chart. This average is known as the signal line, the crossovers of which generate buy and sell signals. This indicator obtains its name from the fact that the two EMAs are continually converging and then diverging from each other. The MACD has gained great popularity over the years, but in effect it's really just another variation on a trend deviation indicator that actually employs two EMAs as its method of deviation. We start off with the price and a 12-day and 26-day EMA. The lower panel discards the raw data and just leaves the two EMAs. Now, the series in the bottom panel is the MACD, which is constructed by dividing the 12 from the 26-day EMA. Let's look at that in greater detail in the next chart. Now the two EMAs are in the top panel and the MACD in the lower one. The equilibrium line represents the periods when the two EMAs are at the same level. Thus, when the 12-day time span crosses below its 26-day counterpart, the MACD itself crosses below the equilibrium line, and vice versa just here. Here's another crossover. When the EMAs are stretched apart, as just here, you can see that the MACD records an overbought condition. The red dashed line is known as the signal line, and it's a 9-period EMA of the MACD itself. The signal line generates momentum Here's a daily chart of Microsoft together with its MACD. Here are the signal line crossovers. They look fairly impressive. But the problem is that they usually come with a fair degree of baggage in the form of whipsaws, such as these two. We still need to see some confirmation, and these signals were accompanied by nice trendline breaks. This signal was as well, but after about a 5-week lag. I've placed the overbought oversold lines at plus and minus 7 in this chart by way of demonstrating that the MACD does lend itself to overbought oversold crossovers. Here are 3 sell signals, and here are 2 buys. 2 of the sells show confirmations following a lag. The second was a better signal since the price broke down from an upward sloping head and shoulders pattern. Now look at this buy. It was confirmed with a trendline break, but turned out to be a whipsaw. I put that in deliberately to show that not all these setups are going to work the way we would like them to, and we should always assume that these whipsaw possibilities do exist. Finally, here's a reverse head and shoulders, but it completely fails because the breakout is coming very close to the 0.7 overbought level. If you'd got in, the violation of this line would have provided a reliable and timely stop-out point. Note in this instance, as nice as the pattern in the MACD may have looked, there was no confirmation from the price. In this example using GE, there is a divergence between the momentum and the price, and this is confirmed. But wait, there's something far more serious going on, as both series complete and break down from a head and shoulders top. This happened to be the start of a bear market, and note that the MACD was unable to rally to its overbought zone and barely made it to the equilibrium point. I mentioned earlier about the excess of whipsaw signal line crossovers, which is why I do not use the MACD on short-term charts. However, when you apply it to monthly data, the whipsaws are usually far fewer. Here we see Verizon, and these are the signal line crossovers. There are a couple of close call whipsaws, but this is the only real one in nearly 25 years of history. I'm not going to say that this happens every time, but monthly charts in my book are definitely less prone to false signals. Here's a confirmation of the first buy signal, and here are some more. Remember, these rallies may not look that long, but this is a monthly chart, and each bar represents a month's worth of trading. Summary. 1. Trend deviation indicators, and here I include the MACD, are calculated by dividing the close, or a short-term moving average, by a longer-term one. 2. Trend deviation indicators can be used with trend lines, price patterns, and moving averages. They lend themselves to overbought and oversold divergence analysis. 3. The MACD is a form of trend deviation indicator.